Welcome to this video. What we're going to be doing is looking at how to improve our analysis of the Forex markets by looking at two of the most influential theories of all time, which we can incorporate in our analysis. Now, these two theories, if you use them correctly, okay, they will help you spot things in the markets that other traders don't see. They'll also basically keep your analysis very simple, and they will stop you holding an opinion too long against market evidence. So the video is really aimed at those people who want to do sentiment fundamental analysis, but also incorporate the technicals in their trading as well. Now, what theories are we going to look at? Well, strangely enough, they both come from religious ministers. The first one comes from a 14th century Franciscan friar by the name of William of Ockham. His theory is called the razor. It's extremely simple to understand, yet it's influenced some of the greatest minds in history. Think Albert Einstein, think today Stephen Hawkins, if you want a trading example. Ed Thorpe, probably the greatest algorithmic trader of all time. He said it was only when he discovered the razor that basically his trading became profitable. Second theory is Bayes' theorem from Thomas Bayes, a 17th century Presbyterian minister. This is one of the most basically influential theories around. Just to give you an example, think the spam filter. It's pretty efficient today, isn't it? Why? Because it uses Bayesian updating algorithms. Think of the Enigma code in the Second World War. That was seen, the cracking of the code as a key to the Allies winning. How was it cracked? They used Bayes' theory. Okay, the US military use it all the time. It's used in medicine. It's used everywhere. Yet most people haven't even heard of it. Is it used in the markets? Yes. One of the biggest and most successful hedge funds around uses it. Now, in terms of Bayes' theorem, it is a mathematical probability theory. I am not going to go into the mathematics in this video. You can look up more details online. I'll give you a couple of good books to read as well. I just want to go through the thinking like a Bayesian in terms of spirit, okay? So you don't actually need to know the mathematical formula to use it. Once you become a Bayesian, you will actually see things in a different light. Now, before we discuss both theories in a little bit more detail, just want to give you a quick summary of both theories and then come back and discuss them in more detail and how we use them to hopefully improve our analysis in the Forex markets. And if you use them correctly, they will help you improve your analysis. So here is the quick summary, then we'll be back to discuss. I'll back up that quick summary there of the two theories. Now, they are simple, aren't they? They're deceptively simple. Bayes' theorem needs a little bit more explanation, which I'll come to in a moment. But first of all, Occam's razor. That should need no explanation whatsoever. But Forex traders just do not understand it. That is why, and I've said this in numerous videos, I'm just going to say it again for anyone who's new watching me. Why so many lines on a chart through meaningless levels? It's complicating something that doesn't need to be complicated. The more lines you put on a chart, they will look relevant because you're bound to hit some of them. They're not important levels. You focus on only the important levels. That's it. Now, traders tend to think, if I complicate it, that means I put in some work, I've been clever, I'll get rewarded. The absolute opposite is true. Ed Thorpe made the point. Only when he simplified his algorithms down did he make money. Now, I don't know Ed Thorpe's algorithms, but I bet you they don't have more than 3 or 4 rules to generate a trading signal at most. That is generally the maximum number of rules that an algorithmic trading system can have that will work. Put in too many rules and it's too complicated, it will just break in real time, okay? So you've got to keep it very, very simple. Simple. I know I've said it before. It is the best way to view a chart. Focus on levels that matter. That is it, okay? Do not overcomplicate charting. Now, Bayes' theory. I said I wouldn't go into the mathematics, which I won't, but if you want to go and read an excellent book, go and read the introduction to Bayes' theory by James Morton, I think it is. Now, in terms of that book, you can see how the actual equation is used in various different disciplines, and it's very effective. You can see how effective it is in finance terms from the fund Rentec. Now, the fund Rentec, very successful. People who run it aren't even traders or have a trading background. They were actually Bayesian linguistic people, okay? They just use the formula in finance and it works. And when I put down they get 1 trillion bytes of data, that is per day. They've got to filter that, okay, and basically make trading decisions. The Bayes equation helps them do that. Now, in terms of being a Bayesian, what you become is you become less convinced about your opinion. You doubt it more, which means you won't suffer from cognitive dissonance, which is a major problem for most traders. And you'll actually see things that other traders simply won't see. Now, cognitive dissonance needs a little bit more explanation, but it's all to do with why you cling to an opinion and find supporting evidence for it and miss evidence that disproves it. I'm just going to give you an example of cognitive dissonance. We've all suffered from it, and we've all done things like what I'm going to show you, which is UK Prime Minister Tony Blair talking about the weapons of mass destruction in Iraq. Now, just look at the way he justifies himself as he goes through the various stages of actually finding out his opinion was actually wrong. It'll take about 45 seconds. I'm just going to show it to you because it really emphasises what I consider to be an important point. Then we're going to talk about cognitive dissonance in more detail and how to get your thinking clean, simple, and able to see what is the truth. Okay, right, here is the example. I'll be back in about 45 seconds. Welcome back after that short summary there of Tony Blair justifying the invasion of Iraq and basically the hunt for the weapons of mass destruction. Now, I haven't shown that for any political reasons, okay? Just shown it to show you his response when the evidence mounts against his view. It doesn't weaken his opinion. It just convinces him that he's even more right. Yeah, it strengthens his conviction. When eventually he is proved wrong, then what does he do? He just basically says he was right to do what he did anyway, but for different reasons. Now, does that happen in Forex trading? Of course it does. Trader comes in, they've got a view, they've got an opinion, they're going to stick with it as long as they possibly can. They don't want to change it. So when the evidence mounts against them, what do? They find evidence, no matter how flimsy, to support their argument. Let's say currency's going against them, it's going up, they'll just say, well, it can't go up anymore. It's got to turn around soon. When eventually they're stopped out, they'll very often say, these markets are just crazy. No one can work them out, or no one could have seen that coming. Now, in terms of fighting your opinion, it does take a little practice. You've got to be aware of it, because otherwise you will stick with an opinion which you shouldn't. Now, in terms of Bayesian's, if you've got Bayesian way of thinking, you see things in grayscale, not black and white, okay? So you're very conscious that your opinion or what you're going to do can go wrong, so you always weigh the counter argument. You assign a probability to your trading signal, and then you keep updating in light of evidence. This is important also in terms of a lot of traders put on a trade, stop, target, just leave it. They update in the light of evidence as it comes out, just leave it in the market. Very often they just get stopped out when new evidence could possibly allow them to get out the smaller loss or even a profit. Now, in terms of Bayesian thinking, you don't think like the majority, okay? In Forex trading, you think in terms of three areas. The fundamentals, obviously, they're important. The sentiment towards them, which is very important. And then you have, probability-based trading signal entry, okay? So you decide the probability all the time in the light of evidence. So I'm just going to show you a quick storyboard again, which actually is Philip Teflock, who basically has researched who the great forecasters are and how they think. And he concludes they all think like Bayesian. So he makes reference to a guy called Tom Minto, who actually is an amateur forecaster who beats professionals in their field. So I'm just going to show you how I think in terms of Bayes when I assign the probability to a trade. It's just a very simple example. You don't quite understand it. I'll explain it in a little bit more detail in a moment. But yeah, Bayesian's always thinking differently, okay, looking for things that other traders don't see, and also very aware of switching their opinion in light of new evidence. So here, just another quick summary, then we'll be back to discuss. we'll go back off that short summary there on just how I assess probability, in a Bayesian spirit, so to speak. So let's say I do have that chart formation. It's been bearish, but it looks like a reversal is coming. Give it 50-50 odds. Then I'll look for supporting evidence from my view. Bearish news fails to push the price lower. That increases the probability of a rebound in my view, because the bearish news is probably discounted. Similarly, if I've got the CFTC net traders positions on my side, i.e. the smart money commercials, that increases the probability. Bearish news pushes the price down, then the probability isn't going to go up, it might go down. If I've got the CFTCs on my side, that means the probability is less as well. Now, in terms of when you're doing this, you always have to update the evidence as it comes in. And if you don't, then you'll find your cognitive biases coming into play. Happened to me last year. Basically, I thought Trump would win the US elections. It's against the majority. And I was really delighted I got that right. I actually thought that stocks would sell off. That would mean the USD would go down on the safe haven JPY. Stocks immediately went up. Okay, USD JPY immediately went down. That's new evidence, which was my warning sign to get out. What did I do? I decided to give it another day. What happened? I came out with a much bigger loss than I could have done. Now, people might say, well, Bayes, you should have been aware of that. Well, we're all human, and those cognitive biases are very powerful, okay? And now I'm actually much more quick to, or I'm quicker to basically update in light of new evidence, take the loss and get out. I don't actually mind taking losses, okay? I've never let my losses get out of control. I've got what I would consider to be decent forecasting ability, so I can get a good amount of trades right. The ones I get right can run my profits and cover my inevitable losers. Now, in terms of the razor, Occam's razor, always keep that in mind as well. I never look at insignificant news. I look at big news events, big things that impact the price. Sentiment, for example. Don't look at small levels in the markets that are insignificant. Keep it simple. Only focus on big levels. So use a combination of Bayes' theorem and the razor, okay? And that works for me, and it works for a lot of people who forecast. Now, Nate Silver, at the conclusion of that last storyboard, said we can never see things totally objectively. We can't, and anyone who says that we can is incorrect. We will see things subjectively, but Bayes' theory, Occam's razor, will help you see things more objectively, which will help you make better forecasts. In terms of Bayes' theory, the person who introduced it to me was Nate Silver when I read his fantastic book, The Signal and the Noise. He's one of the great forecasters of our age. If you're serious about making money from the markets, I'd strongly encourage you to go and read his book. Now, in terms of what we've been discussing in this video, I'm just going to finish up with some quotes from Nate Silver, which kind of reinforce what we've been talking about. They're fantastic quotes. It's a fantastic book. And as you can gather, I just like Bayes' theory and Occam's razor. I encourage anyone who's serious about making money to learn more about the two theories and practice them in their tradings. That's it for today. That's the video. Here are the quotes, and I hope you enjoy them.